Okay, in this first example with the effective interest, we're going to be looking at a discount bond. And so in this example, the bond is being issued on January 1st, 2020, and the bonds pay interest on December 31st each year. And so we're going to do the journal entries for 2020, 2021, and then also for the maturity date on 12/31/2024, assuming that the bond is issued at 96. And so of course that means that it was issued at a discount. And so the first thing we understand is that the issue price is a function of that 96, which is 96% of the par value. And so it was issued for $240,000. And so looking at the initial journal entry, we can see that the cash that was received was $240,000. The par value for the bonds payable is $250,000, which means that the discount must be $10,000. So to this point, the effective interest method and the straight line method are exactly the same. So now we calculate the interest payment, and the interest payment, of course, is the bond rate, 6.5%, applied to the par value of $250,000, which means that each interest payment is $16,250. We're going to take this information, and now we're going to start creating our amortization table. And so the first step to creating the amortization table is actually solving for the bond yield. So we plug in our information. And the first thing we see that this is a 5-year bond and it's annual, so those are 5 annual periods. The present value for the bond is the proceeds that were received from the issuance, which is $240,000. The payment is the contractual interest payment, and the FV, of course, is the par value of the bond. With that information, we can solve for the bond yield. And of course, this is a discount bond, so we would anticipate that the yield would be more than the bond rate, and of course it is. Okay, so now creating the amortization table. The interest expense is going to be the bond yield times the carrying value from the previous period. And then the amortization is going to be the interest expense minus the interest payment. So as we start with the initial issuance, we see that on January 1st, 2020, the initial carrying value of the bond is the issue price of $240,000. After 1 year, you can see that we calculate, or we have the interest payment, $16,250. The interest expense is the calculation of the bond yield, which is that 7.48 and some change percent applied to the previous carrying value, which is $240,000. And so the amortization then is the difference between the interest expense, $17,792, and the interest payment. And so the amount of amortization for the first year is $1,722. And since this is a discount bond, the carrying value is going to increase until it comes to the par value of $250,000. Another way to think about it is that the interest expense is quote unquote how much you owe. That's sort of the economic reality of the transaction, whereas the interest payment is what you actually pay. And so you can see that we accrued more interest than what we actually paid. Therefore, the carrying value of the liability must increase for that difference. And so we complete the table following that same process. Each payment, of course, is the same, and then the interest expense is applying that bond yield to the prior carrying value. Of course, as the carrying value increases, the interest expense is also going to increase, and since the payment is fixed, the amount of amortization each year is going to increase as well, until finally, barring any rounding errors, the carrying value will land at the par value for the bond. So now we're going to use that amortization table to create our journal entries. And so the next journal entry is the payment on 12/31/2020. And we can see that the contractual cash payment is $16,250. That is the amount that we credit cash for. From the table, we can see that the interest expense is $17,972. And that difference then is the amortization of the discount, $1,722. The discount balance is a debit balance, and so it's going to be amortized with credits until the balance in the account is 0. So in the next year, we just keep moving down the table. We can see that the cash payment, of course, is the same. The interest expense reflects the 12/31/2021 interest expense, and the discount amortization is the difference between the two for $1,851. Now, for the final journal entry, not only do we need to record the last interest payment, but we also have to record the fact that the bond is being retired, it's going to be paid back. And so there's a little more going on. First of all, the interest expense is taken from the table, $18,549. Since we're paying off the bond, we do need to debit the bond payable. And now the cash payment includes paying the par value of $250,000 plus making the final interest payment of $16,250 for a total of $266,250. The amortization of the discount, of course, is taken from the amortization table for $2,299. Again, barring any rounding errors, the journal entry takes care of itself and should all balance out.